Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all that corporate mumbo jumbo. This report, well, it's a bit of a mixed bag, like a financial buffet with some real gems and some interesting choices. Today we are dissecting Upland Software Incorporated's quarterly report. This is where they spill the beans on how they've been doing financially. And let me tell you, things have definitely shifted. So what is the big deal about this Form 10? You ask, well, it is their official update for the third quarter of 2025. Think of it as a financial checkup for the company, giving us a peek under the hood to see if everything's running smoothly or if there are any red flags. We are looking at how Upland Software was doing as of the 30th of September 2025. This is their snapshot in time to see where they stand financially, and it's super important for understanding their current health. Let's dive into what they call the condensed consolidated balance sheets. This is like a financial photo album showing us what the company owned and what it owed at two different times. First up, cash and cash equivalents as of the 30th of September 2025, they had about $22.8 million. Now compare that to the 31st of December 2024 when they had a much healthier $56.4 million. That is a big drop, folks. Losing more than half their readily available cash in just 9 months is something to pay attention to. It means they have less money to play with for unexpected expenses or new opportunities. Moving on, look at their intangible assets like brand names and patents. These are down from about $123.9 million at the end of 2024 to $68.6 million by the 30th of September 2025. This significant decrease, nearly halving their intangible value, points to some serious business adjustments. Possibly selling off parts of their business, which we'll get to later. Now, goodwill. This is what happens when a company buys another company for more than the value of its identifiable assets. It is like paying extra for reputation or synergy. Upland's goodwill also decreased from around $261 million to just under $259 million. This isn't as dramatic as the intangibles drop, but it still suggests a re-evaluation or perhaps a partial sale of acquired assets. On the flip side, let's look at liabilities, what the company owes. Total liabilities went from about $424.6 million at the end of 2024 to $328.8 million by the 30th of September 2025. This is a good sign showing they've managed to reduce what they owe. Having less debt generally means less pressure to pay interest and more financial flexibility. Then we have their Series A convertible preferred stock. This is a special type of stock that can be turned into regular stock. The value of this went up slightly from about $123.2 million to $127.6 million. This suggests either more dividends were added or the value of that conversion option increased. And finally, the total stockholders deficit. This is a bit of jargon. When a company has more liabilities than assets, it results in a deficit. You can see it went from negative $18.3 million to a whopping negative $47.3 million. This means the company owes more than it owns, and that gap has widened considerably. This is a critical indicator of financial strain. Now let's move on to how the company made its money, or in this case, how it lost it. These are the statements of operations. Their total revenue took a significant hit. For the 3 months ending the 30th of September 2025, revenue was just over $50.5 million, down from nearly $66.7 million in the same period last year. That is a 24% drop, meaning they brought in almost a quarter less money than before, for the 9 months. Revenue fell from over $206 million to about $167.6 million, a 19% decrease. This is a substantial decline and suggests that their core business is shrinking or has been significantly impacted by something. The main driver of this revenue drop is their subscription and support segment. It fell by 25% in the last quarter and 19% over the 9 months. This is particularly concerning because subscription revenue is supposed to be their stable, recurring income. A big drop here means fewer customers are sticking around or new ones aren't signing up as expected. One of the reasons for the big drop in profitability in the past was an impairment of goodwill and other intangibles. In the 9 months of 2024, they had a massive $87.2 million write-down. In 2025, this number is down to $2.5 million, which is good. But that huge write-down last year clearly shows a past company value that was not sustainable. And what is causing some of this financial turbulence? Well, a big part of it is divestitures. They sold off some product lines which brought in some cash, but also resulted in losses when the dust settled. For the 9 months ending the 30th of September 2025, they recognized a $24.4 million loss from these sales. This is a clear sign that they are streamlining the business, getting rid of underperforming or non-core assets. As a result of all this, the company is still in a net loss position. For the 3 months ending the 30th of September 2025, their net loss was about $1.1 million. For the 9 months, it's a much larger loss of almost $40 million, while these losses are smaller than the massive losses seen in the 9 months of 2024, which was over $109 million. The continued losses are a sign that profitability is still a long way off. Let's look at the cash flow statement. This tells us if the company is generating cash or if it is burning through it. For the 9 months ending the 30th of September 2025, they actually generated positive cash flow from operations, about $18.5 million compared to $14.9 million in the prior year. This is actually a strength. Despite the losses on paper, they are bringing in more cash from their day-to-day business operations. This is crucial. It means they can cover their running costs without immediately needing more money from investors or lenders, for now. Now, financing activities. This is where they borrow money or pay it back. In the 9 months of 2025, they used about $61.6 million for financing activities. Compare that to a massive $192.8 million used in the same period of 2024. This big decrease in cash out for financing means they paid down significantly less debt this period compared to last year. This is likely due to the new loan they took out. Speaking of new loans, on the 25th of July 2025, Upland entered into a new credit agreement. Think of this as a major financial maneuver. They got a new term loan of $240 million and a revolving credit facility of $30 million. This new debt package was used to pay off their old loans. This is a big refinancing. It shows they are managing their debt situation, likely getting better terms or more flexibility. Diving deeper, we find the notes to the financial statements. These are like the footnotes in a book, explaining the nitty-gritty details. Here they talk about use of estimates. This basically means that preparing financial statements involves making educated guesses about future events, like how much revenue they expect or how long assets will last. No company can predict the future perfectly, so these estimates are always present. This section on credit risk and customers is quite interesting. It tells us if the company relies too heavily on just a few customers. Upland states that no single customer accounted for more than 10% of their revenue in the periods looked at, but one customer made up over 10% of their accounts receivable on the 30th of September 2025. This means while they earned revenue from many, a good chunk of the money owed to them was from just one source. That's a point of concern for financial stability. Under fair value measurements, they discuss how they value certain assets and liabilities, like their interest rate derivatives. These are financial tools to manage risk. They are valued using different levels of observable market data. Their interest rate derivatives are mostly valued using level 2 inputs, which means they are based on observable market data but not direct quotes. Here they detail the changes in goodwill and intangible assets, supporting what we saw earlier on the balance sheet. They mentioned divesting product lines, which reduced intangible assets by $31.9 million. They also took a $2.5 million impairment charge on certain intangibles related to sunset assets. This term seems to refer to older, less strategic parts of their business they are phasing out. The income tax section is complex, but the key takeaway is they are still dealing with the impact of US tax legislation. They are also carrying a significant deferred tax asset for which they can't fully take advantage of yet due to past losses. This is where we see the details of their new credit facility. The senior secured loans are around $233.8 million after accounting for discounts and costs. The interest rate on the new term loan was about 10.3% as of the 30th of September 2025. This is a pretty high interest rate, meaning a significant chunk of their cash will go towards paying interest. They also mentioned selling off their interest rate swaps. These were used to manage interest rate risk. Selling them means they are no longer hedging that risk in the same way, and they likely got a cash injection from the sale. They also entered into an interest rate cap agreement to limit interest rate risk going forward. Net loss per S-share shows how much loss is attributable to each share of common stock. In the 3 months ending the 30th of September 2025, it was a loss of 9 cents per S-share, which is better than the 12 cents loss per S-share in the same period of 2024. For the 9 months, the loss per share was $1.56 compared to a huge $4.07 loss per share in 2024. So while still losing money, the per share loss has improved. This section discusses stock repurchases and a tax benefit preservation plan. They authorized a $10 million stock repurchase plan in August 2025, and as of the 30th of September, they had repurchased a small amount of stock worth about 55,597 shares. This suggests they are trying to return value to shareholders, albeit on a small scale. The tax benefit preservation plan and preferred stock purchase rights are designed to protect the company's ability to use its tax losses, or NOLs, from being limited. This is a defensive move to ensure they can still benefit from past losses in the future, especially if there is a change in company ownership. They go into detail on how they recognize revenue, which is standard practice for SaaS companies. They highlight subscription revenue as their main focus, but as we saw, that is where they're seeing a decline. Here they break down revenue by geography. The US is still their biggest market, followed by the UK, Canada, and other international regions. However, in all these regions, subscription and support revenue is down, mirroring the overall trend. This is a critical section that explains the revenue and asset changes. They divested certain product lines in 2025, receiving $15.5 million plus potential earnouts. This is the main reason for the drop in intangibles and revenue. They also incurred significant expenses related to these sales, including a one-time fee of $5.5 million for ending an outsourced research and development contract. Upland considers itself a single operating segment, meaning they look at the whole company rather than breaking it down by product line for reporting. Their main measure of success is net loss. They talk about core organic growth rate, which is a fancy way of measuring growth without including revenue from divested businesses or things like overage charges, which are extra fees customers pay. For the third quarter of 2025, this rate was 2.6%. This means their core business, excluding divested parts, is still growing, but very slowly. Adjusted EBITDA is another non-GAAP measure they use to show operational performance, stripping out things like interest, taxes, and stock-based compensation. For the third quarter of 2025, adjusted EBITDA was about $16 million, and for the 9 months it was around $42.7 million, while they are still reporting a net loss. This positive adjusted EBITDA shows that their core business operations are generating cash. Looking at the results of operations section, we see the detailed breakdown of how revenue turned into profit or loss. Cost of subscription and support revenue decreased by 42% in the quarter and 30% over the 9 months. This is directly linked to the revenue drop from divested product lines. They are spending less because they are selling less in those divested areas. Gross profit, which is revenue minus the cost of revenue, also saw a decrease. For the quarter, it dropped by 17%. However, as a percentage of revenue, gross profit went from 70% in 2024 to 77% in 2025. This means they are keeping a larger portion of the revenue they do earn, which is a sign of improved efficiency. Sales and marketing expenses dropped by 41% in the quarter and 32% over the 9 months. This is a direct consequence of divesting product lines and likely shrinking the sales force associated with those parts of the business. Research and development expenses also decreased by 31% in the quarter and 19% over the 9 months. This is attributed to reduced personnel costs, including ending an outsourcing contract. General and administrative expenses saw a 20% decrease. This includes personnel costs, office leases, and professional fees. The divestitures also contributed to these savings. Depreciation and amortization expenses declined significantly by 45% in the quarter and 38% over the 9 months. This is largely due to the amortization of intangible assets tied to the divested product lines. As those assets are no longer part of the company, their amortization expense disappears. There was a $2.3 million loss on debt extinguishment. This happened because they refinanced their debt, and when you do that, you often have to account for fees and unamortized costs from the old debt, leading to a one-time hit to earnings. Let's talk about liquidity. How much money do they have on hand and how are they managing it? As of the 30th of September 2025, their total cash equivalents and restricted cash was about $23.4 million. This is down from $57.1 million at the end of 2024. That $33.7 million drop is a direct result of paying off old debt and taking on new debt. As mentioned before, their operating activities provided $18.5 million in cash for the 9 months of 2025, an increase from $14.9 million in 2024. This is a positive trend showing that their core business operations are generating cash. Investing activities provided about $8 million in cash in the 9 months of 2025. This cash inflow mainly came from the divestitures of businesses, which brought in $9.1 million. This shows they are not just selling off assets, but also bringing in money from those sales. They have a section on critical accounting policies and estimates. This is important because it reminds us that financial figures are based on management's best guesses about the future, which can sometimes be wrong. So, what is the story here? Upland Software is clearly in a period of significant transformation. They are divesting non-strategic product lines to focus on what they believe are their stronger, higher growth areas. This has led to lower revenues and profits on paper, but importantly, they are generating positive cash flow from their ongoing operations and have successfully refinanced their debt. The big drop in intangible assets and the increase in stockholders' deficit tell us they are restructuring, and it is not without cost. The slow core organic growth and the dependence on a single customer for a large portion of receivables are definite warning signs that need to be watched closely. Overall, Upland Software appears to be in a challenging but not overtly dire financial situation. They are making tough decisions to shed weight and hopefully become more profitable. Can their core business grow fast enough to offset the shrinking revenue from divested assets and show a path back to consistent profitability? The jury is still out. Alright, that is our breakdown of Upland Software Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives like this. And hey, don't forget to check out our Discord community, linked in the description, for more real-time discussions. Thanks for watching, and we will see you next time.